morning. I'm Brian Tugin. This is Markets in a Minute for the week of August 17th. U.S. equities had a generally positive week as stocks rallied on a pair of encouraging inflation reports. Emerging market stocks also saw gains, largely thanks to strong performance out of South Korea. On Thursday alone, the benchmark KOSPI rose more than 3%, pushing the index into a technical bull market with a gain of more than 20% from its low in late July. The rally was largely attributed to a revival in the global AI trade, which boosted shares of Samsung and SK Hynix. And as we've seen for much of the last year, performance for the KOSPI is highly dependent on the daily movements of these two tech behemoths, with SK Hynix and Samsung accounting for upwards of 60% of the index total value. Now moving to the highlight of the week, inflation. We got two different looks at inflation last week in the form of CPI and PPI. Both were viewed positively by investors as they indicated that inflation was not reaccelerating, a key fear following a renewed escalation of the Iran conflict. Starting with headline CPI, we saw a month-over-month change of just 0.1%, while the core number posted a year-over-year gain of 2.5%, its slowest pace since 2021. Now, energy prices did decline on a month-over-month basis, which was expected, but we also saw encouraging moderation across a number of key areas, including shelter, food, and prescription drugs. Moving on to PPI, wholesale inflation decelerated more than expected last month, with the year-over-year headline number coming in at 4.7% compared to a prior reading of 5.5%. The overall assessment here is that inflation is still running above the Fed's target, but it is providing some evidence that the initial Iran-driven energy shock is starting to fade. So what does this mean for the Fed? Well, it does give them a little breathing room as they continue to weigh what action to take at their September meeting. And we saw this reflected directly in futures markets. Looking back to the end of July, directly following the most recent FOMC meeting, markets were pricing a September hike at a 70% probability, one hike by October with certainty, and roughly 1.5 hikes by year end. At weekend, we were closer to 35% in September, just over 50% for October, and less than one cut priced in by year end, a meaningful change in just 2 weeks. This optimism spilled over into bond markets, providing some much needed relief to yields. This particularly impacted the front and the middle of the curve, with the 2- and 10-year yields now 10 to 15 basis points off recent highs. Looking ahead to this week, we'll get the Fed minutes on Wednesday, which should provide more clarity into their recent decision to leave rates unchanged. And then on Friday, we get the Purchasing Manager Index data, or PMI. This will be keenly watched by investors, with any softness supporting the case for a hold at the Fed September meeting. That'll do it for this week. If you enjoyed the video, hit the like button, share it with a colleague. Don't forget to hit subscribe. Thanks for watching. We'll see you next week.